at this stage. Well, we have Mahesh Patil, who's our market master of the day. He's Chief Investment Officer at Aditya Birla Sun Life Asset Management Company. Mahesh, good morning. Great to have you with us here on the program. Prashant here. You know, your note says, why now is the time to invest? So I'm going to just put that to you. 2-3 bullet points. Why do you think so, Mahesh?
Yeah, hi, good morning again. So I think clearly, what we're seeing is that some of the factors, right, which were hurting the growth and the slowdown, what we've seen in the first half of this fiscal year, I think some of these things are easing off. Clearly, we have seen from the fiscal side, there's a boost to consumption, which is there. I think which should kind of translate into better consumption growth, which was weak. On the monetary policy side, we've seen that the tightening which was there in the first half, we've seen that starting to ease off a bit. The policy environment, the new RBI governor has come on board. We've seen that, we've seen the rate cut. We've also seen a great amount of liquidity infusion. Yesterday, they infused around 1 lakh of OMOs to reduce the system liquidity, which was a negative already. And I think that should also spur kind of a growth. So we see, I think even the GDP number which came in for the third quarter was around 6.3%. So I think we are probably well on track again on recovery over here. And next year we should be around 6.5% GDP growth. And even the corporate earnings growth, which this year has seen a big downgrade to earnings, I think slowly, it should start to recover again from the second half of this calendar year. So that's on the fundamental side. But more importantly, I think on the valuation side, after the recent correction, both in Nifty and also in the mid and small cap indices, and the Nifty, at least the valuation now is slightly below the long-term average, the P multiple, if you look at it. And mind you, if you look at the ROE of the Nifty is well above the long-term average. So that means clearly the market, the risk-reward here looks favorable. Having said that, markets can always undershoot on the downside, but clearly for a long-term investor who's looking at a 3-year view, I think this is a good time to dip in. And recently also we've seen that a couple of other positives in terms of oil prices, which have come down below 70. I think that should help to contain inflation. And with that, I think there's a good chance that in the next policy, again, you could see a rate cut of further easing, which could be possible. And also on the global front, the DXY, which was kind of rallying, and we saw sharp rally since September when Trump elections came to power. But that is also now kind of easing up and stabilizing. So I think the pressure of the rupee is also kind of now stabilizing. And the rupee depreciation actually is a kind of a boon in terms of earnings, because I think once this rupee stabilizes, the 5-6% correction would mean that the top line growth of a lot of companies, if you get 50-60% of the top line of corporate India, is somewhere linked to the rupee dollar rate. So that should also, I think, once settle down in the next financial year, that would probably add a bit to the earnings. So I think we think that the worst is looking in. The overall indicators, like if you look at the breadth of the market in terms of number of stocks, which are below 30%, that is at a kind of a highest level what we have seen, except during the COVID crisis and during the global financial crisis. So clearly, it is oversold. It's a good time for long term to really step in, and you might see a slow and gradual recovery from here.
Mahesh, hi. Good to hear that. I think that's almost the near consensus view that it's a good time to start adding to positions now. Perhaps we've seen the worst. But the question is, what next, right? This market, since COVID, has been used to these quick bounces, V-shaped recoveries, right? And it's usually been a very momentum-heavy market where stocks overshoot on valuations on the upside, PSUs, etc. So the question is, from here on, should you create a portfolio for a longer period of consolidation, maybe a more defensive portfolio for the next 1.5 years? Or should you, create a portfolio with animal spirits, which means go back to industrials, go back to stocks, the usual names, whether it is EMS, industrials, CapEx, etc., which led the previous arm or the previous leg of the bull market? What is the approach you would take?
That's a very good question. So I think we would not see a kind of a sharp recovery. I think the market momentum clearly has broken, as we've seen in the last 6 months or so. And there is some amount of pain which is there. Even the corporate earnings recovery will be slow and gradual. So, and on the global front, you'll hear these noises. So I think it will be a market where you will see some bounces, some correction, and it will probably consolidate for some time, right? Because this correction started around since September, so we are like less than 6 months. Normally, it will take at least a year, okay, where the market consolidates and tries to make a new high. That's first. Secondly, is that I think whenever this market undergoes such a sharp and deep correction, what we see is that the sectors or the themes which were doing well in the earlier part of the rally, okay, that leadership starts to change and new sectors starts to emerge. So I think some of the sectors which did very well in the earlier period because of either the growth momentum or because of the liquidity flow which rallied behind some of these stocks, I think that will likely to change. And that's why we think that in this going forward from here, you will see sector leadership clearly changing. For example, like banking sector, right, which has underperformed in the last cycle. We see that sector doing well. Again, a lot of the headwinds there, which were there from the regulatory side, I think that is starting to ease off a bit. The earnings growth will not be as great because rate cuts happen, but a lot of that is pricing. Valuations are reasonable. And if recovery happens in the economy, you see credit growth again coming back over there. Similarly, sectors like, for example, the cement, metal space, which have kind of underwhelmed in the previous cycle, I think these could probably come back. And amongst the sector leaders, okay, which was in the earlier cycle, I think wherever the corrections have happened and valuations become reasonable, and the growth outlook is fairly good, whether it's in the industrials, capital goods sector, I think it will be more stock specific, I think, going forward in those sectors.
Okay, all right. Hi, Mahesh. Good morning. And you're sounding quite optimistic. You know, the other data point was on the technical front. I think the number of stocks in the NSE 500 that were trading below the 200 DMA was the highest. I think even in peak financial crisis, we didn't have 90% of them were trading below the 200 DMA. So that's telling you the kind of pain that we saw from the broader markets in particular. But as you've highlighted in your note, asset allocation is going to be key because you have limited money. But now how would you allocate money? How much to equity, how much to fixed income, and how much to, say, gold? What is it right now? And how has it changed, say, in comparison to 6 months ago? Because at that point of time, I think equity could have been relatively lower. Now, going by what you're saying, you'd like to up the ante, I think, out there. Tell us.
Yeah. No, okay, so I think by and large, I think what we're seeing is that the risk return across asset classes, right, is going to be reasonable compared to the risk-adjusted return in the long term. So fixed income also, we think this year can be a good year, okay, where you could make 8 to 9% return as interest rates come down. Gold is a good hedge. Okay, we've seen that play out last year, also the early part of this calendar year. So that will provide this stability. So an asset allocation fund would be a great approach for investors to time the volatility because we don't see any oversized return in any particular asset class. So that's the first thing. And in terms of asset allocation, so we run a asset allocation, multi-asset allocation fund and balanced advantage fund, wherein we express our views in terms of what is the allocation towards more between equity and debt. So in that fund, our allocation, for example, around 6 months back, used to be around, we were going as low as around 37% or so, and we were around 14% for quite some time. And in the beginning of this calendar year, we slowly started to increase because some of our indicators in terms of the valuation and also some of the counter-cyclical indicators which we look at. So that started suggesting that starting time to deploy. And currently, we are around 62% in that fund. So that suggests how we have moved asset allocation as the markets have corrected and some of the counter-cyclical indicators are suggesting that this is a good time to really enter into the market. Having said that, there could still be drawdowns in the market. I think we're not seeing that there won't be drawdowns. But I think those drawdowns are periods, okay, where one needs to buy because there is really now, at least as a fund manager, I see good value emerging in stocks, okay, which really want to buy from a long-term perspective, which earlier you couldn't really because the valuations didn't really fit into your growth valuation framework.
So the current percentage is what? Equity, debt, gold? Sorry, we just missed that.
So
the exact
currently
numbers.
in a balanced advantage fund, okay, where it is only debt and equity, it is around 62% currently. And in a multi-asset allocation fund, okay, where we don't do too much of our asset allocation shift, but there our equity allocation is around 62%, gold and silver is around 17%, and balance is into debt. And also, we find REIT InvITs also kind of attractive, okay, because they offer IRRs anywhere between 10 to 11%. So we have exposure of around 4 to 5% on REITs and InvITs.
Okay, all right, Mahesh, we will wrap it up on that note. Thank you very much for joining in and giving